Imagine it is October of 1930. You are not a speculator. You are not a gambler. You are not a man sitting in a big city trying to get rich from the stock market. You are a grain farmer in rural Nebraska. Your name is Harold. You have worked the same land for 30 years. You know the seasons. You know what drought feels like. You know what a bad harvest can do to a family, and after a long year of labor, you sell your crop and put $4,200 into the First National Bank in your small town. That money is not a number on a screen. It is next spring seed. It is winter food. It is your family's margin of safety. It is the money that stands between order and panic. Then one Tuesday morning, you drive into town to withdraw $80 for supplies. You expect nothing unusual. You have done this before. You parked in front of the same building. You see the same brick wall. You see the same glass door. But this time there is a line outside the bank. People are whispering. Some are angry. Some are frightened. The doors are locked. A handwritten sign is taped to the glass. It says the bank is closed until further notice. You push forward. You knock on the door. A clerk inside looks at you, then looks away. He will not meet your eyes. He walks into the back. Your money is still inside the building. You can almost see where it should be, but you will never touch it again. Not $1. The bank has failed. There is no federal deposit insurance. There is no appeal. There is no hotline. There is no emergency app. There is only a locked door, a piece of paper on the glass, and the sudden realization that what you believed was safe was never truly stored for you in the first place. Within a few years, thousands of American banks would close their doors in scenes just like that one. The shock was not only that the stock market had crashed. The deeper shock was that the banking system, the place ordinary people believed was the safe part of the economy, could erase the savings of people who had done the responsible thing. They did not gamble. They deposited. They trusted. Then they lost. That is why this story matters. Now, not because 1930 is repeating in the same exact way. History almost never repeats in the same costume. It rhymes through structure. And the structure that made those losses possible has not disappeared. It has been renamed. It has been regulated. It has been insured. It has been made more sophisticated. But the core machine is still recognizable if you know how to look at it. When you place money in a bank, you are not simply putting money in a vault with your name on it. You are lending money to a private institution. The bank becomes your debtor. You become its creditor. And in a crisis, that distinction matters more than almost anything else. Most people do not think this way because the banking system works smoothly most of the time. You tap a card and money moves. You make a transfer and it appears. You log in and see a balance. The system gives you the experience of ownership, but experience is not the same as legal structure. There is a difference between having access to money and owning money in a form that cannot be frozen, delayed, impaired, or repriced. That difference is invisible in normal times. It becomes everything in abnormal times. And one of the most important principles I have learned from studying cycles is this: systems reveal their true design under stress. A bridge does not show its weakness on a calm day. It shows it when the weight is heavy and the wind is strong. A bank does not show its weakness when everyone is depositing and only a few people are withdrawing. It shows it when many people want their money at once. That is why we need to go back to the basic mechanics. The common belief is simple. Money in a bank is safe. The bank building is solid. The government regulates it. Deposits are insured. The Great Depression was nearly a century ago. Surely the system has been fixed. That belief contains some truth, but it is not the whole truth. When you deposit cash into a checking or savings account, the bank does not hold every dollar in a separate box for you. The bank takes that cash and gives you a claim. Your account balance is that claim. The money becomes part of the bank's balance sheet. The bank can lend it, invest it, use it to earn a return, and manage it inside its own balance sheet. In ordinary life, this does not feel dangerous because the bank honors withdrawals. But legally and structurally, you are not the owner of segregated cash. You are an unsecured creditor waiting to be repaid on demand. And unsecured creditors are not at the top of the line when a financial institution fails. This is not a moral accusation. It is not a conspiracy. It is contract law and banking structure. Banks are not vaults. Banks are counterparties. And counterparties can fail. That is the first thing people must understand. The second thing is why this structure exists. Modern banking is built on fractional reserve banking. If you deposit $1,000, the bank does not keep the entire $1,000 idle. It keeps a fraction and lends out the rest. The borrower then spends or deposits that money somewhere else. Another bank receives it, keeps a fraction, and lends again through this process. One original deposit can support many dollars of credit in the system. That is how credit expands. That is how economies grow faster than they would if every dollar simply sat still. And in calm conditions, this can work very well. Deposits come in, withdrawals go out, banks earn interest, borrowers build businesses, households buy homes. The system produces credit, and credit produces economic activity. But every benefit has a paired risk. The benefit of fractional banking is credit creation. The risk is fragility. Banks borrow short and lend long. Deposits can be withdrawn immediately. Loans cannot be called back immediately. A mortgage may last 30 years. A business loan may last many years. A bond may mature years from now. But a depositor can ask for money today. That mismatch is the load-bearing weakness of the system. It works as long as confidence holds. It breaks when confidence breaks. In 1930, confidence broke. A large bank in New York collapsed. Despite its name, it was not a government bank. It was a private institution. It had hundreds of thousands of depositors. When it failed, it sent a signal through the system. People began asking whether their own bank was safe. Then people did what rational people do when they are frightened. They withdrew money just in case. But banking has a cruel feature. When enough people act just in case, they create the event they fear. The bank does not have all the money because the money has been lent out. Once too many people demand cash at the same time, the bank cannot meet the demand. Then the bank fails. When one bank fails, depositors at nearby banks panic. Then those banks face withdrawals. Then the fear spreads. This is a bank run, and during the early 1930s, it spread with devastating force. Thousands of banks failed. Billions of dollars of deposits were wiped out in the money of that time. Those losses were not only losses of wealth, they were losses of trust. Payroll accounts disappeared. Farm savings disappeared. Business operating cash disappeared. Family emergency money disappeared. The lesson is not that every bank is bad. The lesson is that trust is a structural component of banking. Trust is not decoration. Trust is the thing holding the machine together. When trust disappears, the mathematics of the machine become visible, and the mathematics say that not everyone can get out at once. The government later created deposit insurance to restore confidence. That was the FDIC. And deposit insurance is one of the most important stabilizers in modern American financial history. It reduced panic. It gave ordinary depositors confidence. It helped prevent many small bank runs from becoming national bank runs. But we must examine what insurance actually means. An insurance system is not the same as full segregation of everyone's money. It is a fund, and like all funds, it has limits. The deposit insurance fund can handle isolated bank failures. One bank here, one bank there, a manageable number of institutions at a manageable scale. That is what it is designed for. It is not designed to pay every insured depositor in a systemic collapse from cash already sitting in the fund. If several large institutions fail together, the system requires emergency action. The fund borrows. The Treasury becomes involved. The Federal Reserve may have to create liquidity. Political decisions get made at that point. It is not simply insurance. It becomes a system rescue. That distinction matters, because a rescue is discretionary. When Silicon Valley Bank failed, many deposits were above the normal insurance limit. The government chose to make all depositors whole because officials feared contagion. That may have been the correct decision in that moment. But it was not a permanent promise that every uninsured depositor at every failed bank will always be rescued. So if you hold more than the insured limit at one bank, the question is not simply, am I safe? The real question is, if this institution fails, will the government decide that my claim is important enough to protect immediately and completely? That is a different question. It depends on politics. It depends on systemic risk. It depends on timing. It depends on who is failing, how fast it is failing, and what officials fear will happen next. That is uncertainty dressed as certainty. And if you are building a durable financial life, you must be able to tell the difference. Even insured deposits can involve access risk. If a bank fails, regulators may resolve it quickly, but access can still be interrupted while the machinery works. In most cases, that interruption is manageable. But if you need payroll, medical payment, a home closing, or emergency cash during the delay, the difference between insured and immediately available can matter. That brings us to the next piece of the structure, bail. And most people know the word bailout. A bailout means the government uses public resources to save an institution or stabilize the system. After 2008, bailouts became politically toxic. Regulators did not want taxpayers to be seen as saving banks again. So financial systems developed resolution regimes that can impose losses on creditors of the bank. That is a bail. And in a bail, and the bank is recapitalized by writing down or converting claims held by shareholders, bondholders, and potentially large unsecured creditors. Depositors above the insured limit can be part of the loss structure in certain systems. This is not theory. Cyprus showed it in modern Western banking. Depositors above the protected limit at major banks suffered significant losses and saw their balances converted or reduced as part of the rescue structure. That event matters because it showed the hierarchy. The official message was that the system was being stabilized. The practical effect was that some depositors discovered that they were not storing money. They were funding the bank. That is what it means to be a creditor. In Europe, bail-in rules were formalized. In the United States, resolution frameworks also exist to manage failing financial institutions without simply reaching immediately for taxpayer bailouts. The language is technical, the effect is simple. In a crisis, the system has tools to distribute losses internally, and if you are inside the institution as a large unsecured creditor, you are inside the loss distribution mechanism. This does not mean every deposit is unsafe. It means that the form, location, and size of your claims matter. A person with one checking account below insured limits has one type of risk. A business with millions sitting uninsured at one bank has another type of risk. A retiree with proceeds from a home sale temporarily sitting above limits has another type of risk. A family that assumes all bank balances are the same does not understand the map. And when you do not understand the map, you cannot manage the risk. Now, the natural question is, if banks are counterparties and if deposits are claims, where should cash be stored? There is no perfect answer. That is the part most people do not like to hear. They want one safe place, but safety is always conditional. Every asset protects you from one kind of danger while exposing you to another. A principle I use in dealing with risk is to ask, what environment am I preparing for, and what does this instrument protect me from? Physical cash protects you from bank access risk. It cannot be bailed in by a bank. It cannot be frozen by a bank's online system. It cannot be delayed by a failed transfer in a deflationary collapse. Cash can become very powerful because prices fall and liquidity becomes scarce. That was part of the Great Depression dynamic. But physical cash has its own risks. It can be stolen, it can burn, it earns no return. And in an inflationary environment, it loses purchasing power every year. In a severe inflationary collapse, physical currency can become a melting ice cube. So holding cash outside the banking system is not a universal solution. It is a tool for one kind of risk. Treasury securities are another tool. When you buy a Treasury bill, note, or bond, you are lending to the United States government rather than to a private bank in a dollar-based system. Treasuries are generally treated as the safest dollar-denominated assets. They sit at the core of the financial system. They are used as collateral. They are deeply liquid. They represent the credit of the sovereign, but they also have trade-offs. If you hold Treasuries through a brokerage, you still have an intermediary. The securities may be protected differently from bank deposits, but access during a brokerage failure can still be delayed. If you hold them directly through Treasury Direct, you reduce intermediary risk, but selling quickly or moving money can be less convenient. There is always a trade-off between safety, liquidity, convenience, and yield. Money market funds are another example. Many people think of them as cash. They are not cash. They are securities that invest in short-term instruments. They can be conservative. They can be useful, but they can also face stress. In 2008, a major money market fund broke the buck. Investors panicked. Redemptions became an issue. The government intervened. Again, the lesson is not that money market funds are bad. The lesson is that cash equivalents are not always equivalent under stress. You must know what you own. Gold and precious metals solve a different problem. Gold is outside the liability structure of banks and governments in a way that paper claims are not. It cannot be printed by a central bank. It has held value across long periods of history. It is a form of money that does not depend on a debtor's promise to pay, but gold has its own risks. It produces no income. It can be volatile. It must be stored. If it is stored in a bank-safe deposit box, it may still be hard to access during bank closures. If it is stored privately, it introduces security risks. And history shows that governments can impose restrictions on gold ownership under extreme conditions. So gold is not perfect either. It is a hedge against certain forms of monetary and counterparty risk. It is not a solution to every problem. Foreign currencies and foreign accounts provide another type of diversification. Holding money in another jurisdiction can reduce dependence on one country's banking system, one currency, and one legal regime. A Swiss franc, a Singapore dollar, or a bank account in a jurisdiction with strong property rights can change the structure of your exposure. But this adds complexity. Currency risk appears. Reporting requirements appear. Legal systems differ. For Americans, foreign accounts above certain thresholds must be reported. Failure to report can create severe penalties. Offshore banking may be legal, but legal does not mean simple. So foreign diversification can be powerful, but it requires competence and compliance. Real assets offer yet another kind of protection. Land, property, productive assets, and useful commodities exist in the physical world. They are not merely claims on an institution. They have utility. A piece of productive land can grow food. A rental property can provide shelter. A business can produce goods or services in inflationary environments. Real assets can preserve value better than cash, but they are not liquid. You cannot walk into a store and spend a farm. In deflationary crises, real assets can fall sharply because credit contracts and buyers disappear. Again, no perfect solution, only trade-offs. The mistake is to think the solution is to flee from all banks or to trust all banks blindly. Both are simplistic. The better principle is diversification across structures. Do not put all your safety in one institution. Do not put all your liquidity in one form. Do not put all your purchasing power in one currency. Do not put all your confidence in one promise. That is how resilient people think. They prepare for a range of outcomes rather than betting everything on one outcome. In every banking crisis, losses are distributed, but they are not distributed evenly. In the early 1930s, small depositors in small towns paid heavily. They lacked information, they lacked options, they lacked political power. They had trusted local institutions because that was what responsible people did. In Cyprus, large uninsured depositors were hit directly, while ordinary citizens also faced restrictions and access problems through capital controls. In Argentina, bank accounts were frozen, deposits were forcibly converted into weaker currency. The middle class saw purchasing power destroyed. The pattern is not identical across countries, but the deeper principle is the same. The people who assume the system is simple often pay the price when it becomes complex. The people who understand structure before crisis have more options when the crisis arrives. Options are a form of wealth. Liquidity is a form of wealth. Access is a form of wealth. And knowledge of how claims rank in a crisis is a form of wealth. Now, look at the modern banking system. It is more sophisticated than the system of 1930. It is also more interconnected. Banks own assets that depend on interest rates. They hold securities, they rely on confidence, they are tied to other institutions. They operate in markets where information moves instantly. In 1930, a bank run required people to stand in line outside a branch. Today, a bank run can happen through phones. Depositors can move money in minutes. Rumors travel faster. Balance sheet stress becomes public faster. The same structural weakness exists, but the speed is different. Silicon Valley Bank collapsed with extraordinary speed because deposits were concentrated, uninsured, and digitally mobile. The bank held long-duration securities that lost market value when interest rates rose. When depositors wanted money, the bank had to sell assets at a loss or raise capital. Confidence cracked. Withdrawals accelerated. The institution failed. That was not 1929, but it rhymed with 1929. Short-term liabilities, long-term assets. Confidence as the load-bearing wall. Losses hidden until liquidity is needed. Then everything happens quickly. When interest rates rise, long-duration bonds fall in market value. Banks that hold those securities may have unrealized losses. If deposits remain stable, the bank may not need to realize the loss. But if depositors leave, the bank may be forced to sell. Then accounting becomes reality. This is why interest rate cycles matter. They do not only affect mortgage rates or stock valuations, they affect the hidden stability of bank balance sheets. If inflation stays high, central banks may keep rates elevated. That pressures banks holding low-yield, long-duration assets. If central banks cut rates aggressively to relieve the banking system, inflation may reignite or the currency may weaken. That is the policy trap. Every path has a cost. In a system built on debt and credit, there is no painless exit from excess. There are only choices about who bears the pain, when they bear it, and how visible the pain becomes. This is where many people misunderstand risk. They think risk is only volatility. They think if the number on their screen is stable, the asset is safe. But some of the greatest risks are not visible until access is impaired. A bank account does not fluctuate every day like a stock that makes it feel safe. But the lack of fluctuation does not mean the absence of risk. It means the risk is hidden in the structure. Stock prices show volatility, daily banking risk appears suddenly. That is why calm can be deceptive. The surface can be smooth while the balance sheet is strained. When you study history, you learn to respect hidden leverage. You learn that what matters is not only what you own, but how you own it. A treasury held directly is not the same as a bank deposit. A bank deposit under the insured limit is not the same as an uninsured deposit. Physical cash is not the same as a checking balance. Gold in your possession is not the same as gold held through a product. Real assets are not the same as financial claims. These distinctions are not academic. They are the difference between having options and waiting for permission. But I want to be very clear, this is not an argument for panic. Panic is usually a bad decision. Making environment, the goal is not to predict the next bank failure. The goal is to build a structure that can survive if something goes wrong somewhere. Good risk management is done before the emergency. Once the doors are closed, once the transfer system is overloaded, once the government has imposed controls, once the bank has entered resolution, once everyone is trying to move at the same time, it is too late to build optionality. Preparation is quiet. Crisis is loud. The time to understand your banking exposure is not when a headline appears. It is when things are calm enough to think. That means asking simple questions. How much money do I hold at one bank? How much is insured? How much is uninsured? How quickly could I access money if one institution froze withdrawals or failed? Do I have liquidity outside a single bank? Do I understand the difference between deposits, securities, money market funds, treasury bills, and physical cash? Do I have records? Do I have a plan for short-term expenses if access is interrupted? Do I have all my assets in one legal system, one currency, one institution? And one assumption, these questions are not paranoid, they are prudent. Prudence is not fear, prudence is respect for reality. One of the biggest mistakes people make is confusing the normal state of the world with the permanent state of the world. Most of the time, banks open, transfers work. Insurance is enough, regulators manage failures. Credit flows, markets function, but history is shaped by the rare moments when normal breaks. And when normal breaks, the consequences fall hardest on people who never asked what would happen if it did. The system is not evil, it is a machine. Machines do what they are designed to do. Fractional reserve banking is designed to create credit from deposits. That credit supports growth. It also creates fragility. Deposit insurance is designed to maintain confidence. It also has limits. Bail in rules are designed to resolve banks without taxpayer bailouts. They also create creditor risk. Emergency lending facilities are designed to stabilize the system. They also reveal that the system sometimes needs extraordinary support. The language changes, the structure remains. A bank is a counterparty, a deposit is a claim, confidence is the foundation. And when too many people want out at once, not everyone can exit at the same time. That is the core lesson. Harold in Nebraska did not lose money because he was foolish. He lost money because he trusted a structure he did not understand. Millions of people in financial history have made the same mistake in different forms. They trusted ratings in 2008, they trusted regional banks in 2023, they trusted capital controls would not happen until they did. They trusted that uninsured balances were effectively guaranteed until they discovered guarantees can be political. They trusted that access meant ownership, and in crisis, access and ownership separated. This is why I think in terms of systems and layers, a resilient person does not need to abandon the banking system. That would be impractical and unnecessary. Banks are useful. Payments require them. Businesses rely on them. Modern life is built around them, but useful does not mean risk-free. So the right approach is not blind trust. It is structured trust. Use banks, but understand them. Use insurance limits, but do not pretend limits are infinite. Use treasuries, but understand custody. Use money market funds, but understand they are securities. Use cash, but understand inflation and theft. Use gold, but understand storage and policy risk. Use foreign diversification, but understand reporting and currency risk. Use real assets, but understand illiquidity. No single form of wealth protects against every risk. The strength is in the combination, that is the principle of diversification, but not the shallow version people usually talk about. This is not just diversification among stocks. This is diversification among claims, jurisdictions, liquidity profiles, and counterparties. It is making sure that if one door closes, you are not trapped in the room. The people who survive large cycles are not the people who predicted every turn. Nobody does that well enough. They are the people who avoided being forced to act at the worst possible moment. They did not need to sell because they had liquidity. They did not need to beg for access because they had alternatives. They did not need to trust one institution completely because they had spread their risks. They did not need to understand everything during the panic because they had done the thinking before the panic. This is how you convert uncertainty from a threat into a manageable condition. History gives us the autopsies. It shows us where bodies are buried in the structure. It shows us the repeated pattern. First, confidence is high, then leverage builds, then the mismatch becomes large, then something causes doubt, then liquidity is demanded. Then the system reveals that the money is not sitting where people imagined. Then authorities intervene. Then losses are distributed through failure, inflation, bail-ins, delays, controls, or currency changes. Then, after the damage is done, new language is created to reassure people again, and the cycle begins in a new form. That is why the lesson of 1929 is still alive. It is not that we are about to repeat the exact banking collapse of the Great Depression. It is that the basic architecture of credit, confidence, and claims still contains the same fundamental vulnerability. The building has been remodeled. The foundation is recognizable. If you understand that, you do not have to live in fear. You can live with clarity. You can hold enough liquidity for emergencies. You can avoid concentrating uninsured deposits unnecessarily. You can understand what your bank actually owes you. You can avoid confusing convenience with safety. You can separate operating money from long-term stores of value. You can think in probabilities instead of certainties. You can prepare without predicting. That is the most important point. I do not know when the next banking crisis will come. I do not know which institution will be weakest. I do not know how regulators will respond. I do not know whether the next stress will be caused by interest rates, credit losses, derivatives, real estate, political conflict, currency pressure, or something no one is discussing yet, but I do know the principles. Too much maturity mismatch creates fragility. Too much leverage creates instability. Too much confidence in a structure people do not understand creates vulnerability. Too much concentration creates forced dependence. And in a crisis, the person with no optionality pays a high price. So do not wait until you are standing outside a locked door, looking at a sign on the glass, trying to understand what happened. Do the thinking before that. Know what a bank is. Know what a deposit is. Know what insurance covers and what it does not cover. Know the difference between a promise, a claim, an asset, and access. Know that the system can be stable for a long time and still fragile under the wrong conditions. And know that the purpose of studying history is not to become fearful. It is to become harder to surprise. The farmer in Nebraska believed his money was in the bank. In a sense it was, but in the deeper sense, it had already been transformed into a claim on a fragile institution. That distinction destroyed him. It does not have to destroy you. The pattern is old, the language is modern, the lesson is simple. Your money is not safe because a building looks safe. Your money is not liquid because a screen shows a balance. Your wealth is not protected because a system has worked in normal times. Your safety comes from understanding the structure, respecting the trade-offs, and building enough optionality so that when the next crisis arrives, you are not forced to rely on one promise at exactly the moment that promise is under stress. That is how I think about money. That is how I think about banks. And that is why the most important question is not, will the next crisis happen? The more useful question is, where is my money legally and structurally when the next crisis comes? Most people never ask that question until it is too late. The people who ask it early are not pessimists. They are realists. And realism in a world built on cycles is one of the best forms of protection you can have.